back, ladies and gentlemen, to the last leg of this one-day seminar on real estate, GST, estate planning and retirement planning. The last session is on the various issues in GST from the real estate perspective. To chair this session and share his knowledge on this, we have renowned speaker, B.D. Chandrashekar, a chartered accountant by profession. I request Somarna to kindly escort B.D. Chandrashekar onto the dais. And also present him a bouquet. Friends, B.D. Chandrashekar is a commerce graduate from Vijaya College. He had secured 40th rank in CA Foundation exam. He is currently the partner of Messrs. Shekhar and Yatish, a firm of chartered accountants, and he is presently in his 19th year of practice. He is a member of Artha, a forum on indirect taxes, Akshara, a forum on taxation and general development, and he is also a member of the Federation of Karnataka Chambers of Commerce. He has presented various papers at various forums to both industry and chartered accountants in the field of indirect taxes, and he is one of the members of the GST faculty of ICI. With this introduction, I welcome Chandrashekar. Over to you.
I think with a long session since morning, so we have varied areas which have been covered, and I think each one is totally different in its each topic was different, where we have learned a lot of things which we could probably implement in our planning, and this is one of the areas where it is more into the issues. What are the areas which we are trying to look at with respect to the goods and services tax with respect to the real estate? Real estate being one of the sector which was affected the most in this particular implementation of the GST, because you have been seeing that a lot of the values were not getting captured. Actual values were not getting captured, even though the impact basically of demonetization, or if you look at any of these valuations which were being done, was mainly affected here because a lot of cash transactions were happening, and now we have seen that that is also getting getting into a place where it is getting settled down because of even the parallel implementation of RERA, which has brought down a lot of maybe professionalism in the investment, whatever we are trying to look at in the real estate sector. So with this, in this particular session, I am going to just look into aspect of few of the key concepts and legal aspects with regard to the GST, which would have a direct impact on the segment. Then different models which are there at present under the real estate and related issues possible, we'll just be looking at. What happens in case of cancellation or an assignment of the property, what happens? Then it could be contractors or who are the people who actually work on these real estate projects, and what could be the taxability impact. Then we look at few of the registration or the ITC related issues, then movement of goods from one project to other, what or how is it going to look at, then what are the records and accounts to be maintained with regard to the real estate segment. Then we could also take up a few of the questions and answers. We try to see if we could take it at the last, whatever issues are there. So here, real estate sector, what does it all comprise of? There are so many areas which could be looked into. More than 30-40 areas we could actually earmark, but I have just mentioned a few. One is real estate, generally what we look at from the owner share. So as an owner, I own a particular property. What happens if I sell it? Then I have a property, I construct and I sell, then a developer, or if I want the construction to be done, there it could be a contractor, or there could be a developer, or there could be a builder for this particular land. So there are developers. What is the taxability of this? Then could also look at before getting into I want to buy a plot. Then in a plot there is somebody who has bought a plot and he develops the plots. and I buy a plot from him out of the total layout or something, then what is the taxability we are trying to look at there? Then it could be the contractors, then it could be the manufacturers who are supplying goods, it could be the cement industry, steel industry, it could be the plumbing, electrical materials. There are so many things who are there as a part of the thing. Then if you want to sell a property, then you have the agents or the real estate sector agents, the estate agents. Then for that you might go into advertising, and what could be the taxability on that particular event. Then you could have, so if you need to construct, then you have the service providers. It could be a legal service, it could be a management consultancy service, it could be an engineer, it could be an architect. You could have multiple things which are there as part of the entire real estate sector per se. So we are looking at the gamut in totality. Then now we will look into the dictionary meaning of the word real estate. What does it mean? It means land or anything fixed, immovable or permanently attached to it, such as appurtenances, buildings, fences, fixtures, improvements, roads, shrubs and trees, but not growing crops. So because that's a part of agriculture, they don't want to include that. Sewers, structures, utility systems and walls. Title 2, real estate normally includes Title 2 air rights, mineral rights and surface rights, which can be bought, leased, sold, transferred together or separately, also called as real property or realty. So when we are looking at the total thing, so anything which is getting fixed into a land, so which is going to be fixed, means if we have to remove it, there has to be a damage which is supposed to take place. If there is some damage and there is a minimal damage and we are able to use that particular property again, then probably there also a few of the courts have held that it is not a immobile property. So it depends on the attachment what we are trying to look at. Say in this room there are a lot of things which could be called as movable if you are immobile. For example, this POP, this false ceiling which is done, this cannot be a movable property, provided if there is a mechanism to remove it without much of destruction and I get a pieces as it is which I can use it somewhere else, then I can still call it as a movable. So how is this structure, how is this particular thing utilized? That is what is supposed to be looked into. So as per the constitution also, land falls within entry 49 of the state list of the constitution, where there is an exam, that particular subject matter is a state subject. So the state is going to tax this particular transaction. So any land or right in land is supposed to be taxable, or any levy is to be given by the state governments only. So that only the state has the authority to levy it. So they tell that, so a central authority or any other authority cannot directly or indirectly tax the land. That is what they want to bring here. So GST, so that's why GST on land cannot be directly or indirectly with respect to, they cannot levy this particular tax. That is what is the crux. So that is the reason why they have included this particular land, sale of land and sale of building, if you see, is there as a part of third schedule. Third schedule to the GST provisions has very clearly indicated that any sale of land or sale of building is not taxable unless and until it is falling under schedule 2, serial number 5B. So that is what is one exclusion, so that we will discuss later on to understand it in more detail. So GST is levy only on anything which is relating to goods or services or both. So first there has to be a supply, and that supply, whether it is in relation to goods or whether it is in relation to service, we have to identify whether it is a supply at all per se. Then after that we are going to identify whether it is goods or service. That is what is the chronology we are supposed to look at. So, with regard to this, finally we should conclude that there cannot be a tax on sale of land or sale of building. That is what is the, that is GST tax cannot be levied on this particular transaction. That is what is about the constitutional background. So under 2(119) of the CGST Act has defined what is works contract. So it is a contract for building, construction, fabrication, completion, erection, installation, fitting out, improvement, modification, repair, maintenance, renovation, alteration or commissioning of any immovable property. See, this immovable property has been added in this particular GST regime. Earlier, the word immovable property was not there. So any contract which was in relation to, it could have been even a movable property, or any transaction of erection, commissioning or installation could have been a part of a movable property, or any other transactions could also have got covered under the earlier regime, whereas now we will not be. It is specifically the works contract, whatever they are trying to look at here is only with respect to the immovable property. So this is what is one of the important aspects which has to be seen. So next, in para 6A of schedule 2, they have told composite supply of works contract as defined under 2(119). So here they have told that works contract is a service. So earlier, under the earlier regime, we had a works contract. What was being charged by the VAT department because of 366(29)(a) of the Constitution, which defined works contract, there was property in goods in the execution of works contract was the aspect which was supposed to be captured. That is what was supposed to be taxed. But here they are telling it is a service per se. So they are not telling. So any works contract becomes a service, and there is no dilemma in this particular transaction whether it's a service or as a goods. So it is going to be a service as defined. But there is a issue because under the Constitution there was a definition which of a works contract as per 366(29)(a), which told that any transaction with regard to execution of during the execution of a works contract, the property in goods only was supposed to be taxed. So they defined goods there, but here they're trying to charge it as a service, which is not correct in few of the when we look at the analogy, and this could be litigated, and probably this has to test waters. Probably this will take up once the litigation comes into, they will surely take this matter further. Then we understand a concept called composite supply. What is composite supply under 2(30)? So composite supply means any supply which is made by a taxable person to a recipient, which consists of two or more taxable supplies naturally bundled. So in which one of them has to be a principal supply. For example, to understand this particular thing, we'll understand it by way of an example. I want ducting, I want to buy an AC. The AC has to be fixed with respect to this particular hall. I want a AC to be fixed. So I buy an AC and installation comes free with this particular AC. So can I call it as a composite supply, or is it supply of AC is separate and installation of this is separate? So because there it could be that AC is say 28,000. One AC of 1 ton is 28,000. 2,000 rupees is for installation. He charges me 30,000. Or that could be one scenario, or it has the AC is 30,000, installation is free. That could be another option. So what is the aspect we are trying to look at here? Whether it is free. So we are supposed to look at whether the aspect in each and every aspect, whether when we bisect a particular transaction, whether each and every transaction was taxable and whether it was together a taxable supply. And in this regard, when there is two or more taxable supplies which are naturally bundled, so when it is naturally bundled, so whether I call it as completely a supply of only an AC and installation becomes incidental, then in that particular transaction, what is the value of AC? AC could be at the rate of 28%, it's a higher rate of tax, and there even the installation becomes a part of the composite supply, because that is the principal supply. I want to buy AC and installation is only a incidental thing. But if installation itself is separate per se, when we are looking at this transaction, then in that particular transaction, what is going to happen? Installation becomes a separate transaction and supply itself could be a separate transaction. So in long run, it could depend on the actual understanding between the buyer and the recipient and what sort of a transaction is that has to be looked into. Then we get into an aspect which I was trying to tell. In schedule 3 there is an exclusion to the extent that if an aspect of this construction of complex, this is schedule 2 para 5b, which talks that anything which is in relation to a construction and that particular transaction, construction of a complex, building, civil structure or a part thereof, including a complex or a building intended for sale of a buyer wholly or partly, except where the entire consideration has been received after the issuance of a completion certificate. So once I am a builder or landowner, I have bought the land, I have constructed the property, and after if I get the CC or completion certificate or the first occupation, if I am not able to get the CC, maybe because there is a violation, so I am not able to get the CC, then in those particular transactions, the first occupation, I have to prove the first occupation. So how to prove the first occupation? Maybe it could be the first rental agreement or your handover of the possession of the first by way of an allotment letter or by way of a sale deed which has been done, and to prove by way of having the first electricity meter generated where the electricity is generated. Electricity is used or water supply, whatever is there. So this particular thing defines that after, if I have sold this property, after this particular transaction happens, then there is not going to be a tax, GST on this. This becomes on the third schedule. So what are we deriving? We are deriving that anything which is there in the course. So once I have started the foundation and during that time I am trying to collect the advances for the particular construction, then in that particular transaction will be subject matter of levy. Okay. Then consideration. So consideration, what is the different types of consideration? How consideration can be looked into? So any payment made or to be made, whether in money or otherwise, it could be monetary or non-monetary. So because they have told whether it is monetary or non-monetary, forbearance of an act, then with respect to the supply of goods or services or both, whether by the recipient or by the third party, not to include any subsidy given by the central government or state government. Deposits not to be included as consideration. So any deposit which is in the nature of refundable deposit only should not be included, but if it is a part of a non-refundable deposit, then we need to test the waters whether it is in relation to immobile property or not. If it is in relation to immobile property, then that will not be taxed, else that transaction is going to be taxed per se. Before we get into the actual discussion of different types of transaction, we will understand what is supply. See, supply is the main crux of the GST law per se, whatever we are trying to look at. So here section 7 defines what is supply. Supply is nothing but supply, all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, license, rental or lease or disposal. See here even disposal, if I want to discard a particular asset or dispose a particular asset also, I will be liable for GST. That particular transaction, and this has to be made for a consideration. So there has to be a consideration. So a quid pro quo. So anything, there has to be something in return. If there is nothing given as in return, if you are not getting back anything, for example free samples, I am not getting anything in that, so there could not be a taxability. So here with regard to, and it has to be furtherance of business. So if it is in the furtherance of business, this will be taxable. So here there was one clause called 7(1)(d) which told that activities which are referred to schedule 2, such as goods or services, this has been omitted. So first what we were doing is, because of this particular 7(1)(d), so anything which was listed in the second schedule could also be treated as a supply. So because what was the wordings? So supply include activities which are referred to in schedule 2. But now there was an amendment which took place in August, but as of now this is still holding good, because what is the reason why this was not implemented immediately? Because we did not get, all the states have not signed. Out of all the states, only 23 states have approved the amendments which took place in August 2018. Because of that, and in the recent GST Council meeting, they have told that once these amendments take place, the supply definition is going to change. So this they want to give it effect with effect from 1 to 2019. So with effect, at least they want to do it within this particular month. So they want this. So they have introduced one subsection with section 7. So here they are telling any activities or transactions constitutes as supply under subsection 1. So first whatever it has to satisfy the definition of 1 ABC, there are 3 points of a supply definition, and now they are telling that only if it satisfies a supply definition, then under schedule 2 you are going to identify whether it's a goods or service. That's all. So in schedule 2, earlier whatever is there, but this is going to come effective only after the complete notification by all the states. So this is one aspect which has to be kept in mind, and it is given a retrospective amendment. So this is the retrospective change which with effect from 1/7/2017 only. So this is one aspect which has to be looked into. Then valuation. What is generally a valuation between for a particular transaction? It is the price actually paid. So I am selling a particular apartment for 1 crore. 1 crore is the total value. So that becomes the actual value. So anything which is paid indirectly from the buyer to the seller is, if there is some indirect amounts which have been given, it could be direct or indirect. If there is a linkage between a particular thing, the buyer has given a interest-free loan or something like that. So this could be a possibility that there could be deemed income which could get added to the transaction value. This aspect has to be kept in mind. So here the supplier and the recipient should not be related persons. So if they are related persons, then the valuation mechanism could be changed. So there could be a requirement of open market value, or there are other methods which it could be cost plus method. So where we try to see what are the different methods and go based on the methods if they are related persons. And price is the sole consideration. So price has to be a sole consideration with regard to the transaction. So now we come into the main crux, which is the different models which we are trying to understand. So in the first model we are going to look at land and construction is done by the same person. So land is also held by the same person and it is sold after construction or during construction, we will see that. Then developer provides only construction services to landowner. So landowner is going to provide the material and the developer is going to provide a pure labor services, could be possible, or the landowner is giving the entire contract to the developer or builder. Then the third one, which is the joint development agreement, whatever we are trying to look at JDA transactions. Why did JDA transactions come in picture? Because the land values have escalated, and because developer, if you had the amount to buy the property, you would have bought the property and you would have done the development and you would have sold it. That could have been, now even today there are few transactions happening in that. But when the land values are escalating so much that today 40-60 site will be costing you, say in Jayanagar, it will cost you about 5 crores. So 5 crores, the people are not ready to invest so much of money. The developer always looks at making money in the short-term projects. So when he looks at for a year, he has to invest 5 crores plus on the construction and he has to take out his money. So the transactions are, the development activity cost is going to go up. So that could be one of the methodology why the transaction where the joint development activities have come into picture. Then we are going to look at the layout development, tenancy rights and EPC contracts. So here the first one is the land and construction. So I buy the land, then I construct either a building or a villa or a complex or a civil structure and I sell it. So there is X person, he buys a land and he constructs. During the course of construction, so we are clear that after the construction, after OC or CC we get, then if we sell there is no tax. So we are concerned about the aspect where we are going to look at if it is under construction, what is the valuation. So here the rate prescribed is 9 plus 9, 18% for this particular construction services, and there is a deduction which is given to the extent of 1/3 of the total value. So few of the people call that in these transactions the actual rate is 12%, that is how they calculate, but it is not an actual rate of 12%, it is 18% minus deduction to the extent of 1/3, which is 6%, which net comes out to 12%. So that is how we are going to look at it. And with this deduction value, so what is the deduction? How is it got its truth? So that has been given by way of a notification for valuation purpose only. So valuation purpose, how the valuation has to be given? This is given in notification 11 bar 2017 entry number 3 para 2, where it clearly mentions that the total amount, out of the total amount, will be giving a deduction to the extent of UDS to the extent of 1/3 of the total value. Okay. So this is a deemed deduction sort of a thing is given and the value has been charged. Okay. Then what are the questions on mind? We get whether a notification can provide for a deemed deduction of land. That is one question which is there in mind. Whether land value is to be included in the value of supply. Because as per the understanding, I told you, I gave an example of Jayanagar. Jayanagar, the rate of land is about 20,000 rupees. 1 square feet land is 20,000 rupees. I am able to build 4 floors, assuming. So what is the cost of per square feet? 5,000. And for construction, approximately about 2,000 will give. So it is totally 7,000. Okay, my profit margin of about 500, 7,500 is the square feet what I charge to the customers. So out of 7,500, I am given only a deduction of 30%. How much will that come up to? 2,250 roughly. We can keep that. So about 2,000. So if they give a 2,000, but my land cost, how much is actually I paid? 5,000. But if we go to an area of electronic city or something, the land value is only 5,000 rupees. So I also built there also only 4 floors. So out of 5,000, if it is per floor, what is the amount we are getting? 1,250 plus 2,000 is my construction cost. So 3,750 plus 500 rupees margin, 4,250. So there out of 4,250, if I am given a deduction of 30%, which is about 1,200 rupees, if I get a deduction of 1,200 or 1,250, then my cost is only, I have to collect tax on 3,000 at the rate of 18% effectively. So in the first transaction, the land cost is higher. So are you willing to pay GST on that, which is an indirect way of taxing this particular transaction? So here in this particular transaction, we can even today take a contention just because there is a deeming fiction in the law. I need not go by the 1/3 mechanism, because this sort of there was an example with respect to Wipro. Wipro company, they had imported a particular hardware, and that hardware they had a 1%. Generally, you know that there is a 1% on the FOB value. When we import a transaction, they charge about 1% of the transaction as freight and handling charges, 1.25% totally it comes to. But when they went into the actual calculation, that worked out lesser. The actual freight was lesser. It came to only about 0.5% of the total transaction value. So there, in this particular decision, this was under the service tax regime, where they told that the handling charges, if you have supporting documentation to prove that this amount is allowable, then even today, with the same analogy here, we can also look at here for this particular transactions also we can look at, we need not specifically go for 1/3 deduction if we have supporting documentation to prove that either there is a guidance value to prove that there is the transaction of land is much more than 1/3 of deduction, or it could be I have construction, I have bought it. So because what happens many a times, Jayanagar, today if I have to sell, I would have bought it, the property I have bought it 10 years ago. 10 years ago I would have bought it only at say 8,000 or 10,000 rupees per square feet. Today it is 20,000 rupees. So guidance value could play a vital role. But if I bought the property recently, I have a sale deed to prove that particular transaction. So these transactions could be examined, should be examined in such particular manner, and it is not that just because a deduction is given by way of notification, generally either it has to be in the act. So it is like they tell that the tail and the dog story. So it is the tail which has to wag and not the dog. So here we have to look at the dog has to wag its tail and not the tail wagging the dog when we are looking at the transaction. So it is a notification. So notification cannot determine a deeming provision. So that is one of the examples we could take. And with this regard, there is a possibility also where in South India generally or in Karnataka we see that we have more of documentation. Earlier we have been following a dual agreements, but as per RERA they have been telling that it has to be one agreement only. But even today there are few of the, even after the RERA modifications, in few of the places like Chennai they are even today following two documentations, one for transfer of UDS and one for construction. They are still following that mechanism. Or in the agreement, is it really possible for us to show a bifurcation between the land and the construction? Can I bring it, even though it's a single document, can I bring that particular value in the document to still satisfy RERA as well as your GST provisions, so that we need not pay a higher tax, because the customers are indirectly affected with this particular transactions. So this is one amount which we need to look at. And there is one aspect about this notification. When we look at the 1/3 deduction what has to be given, because there is something like a deemed value which has been prescribed as sale of land. So here there is some confusion whether input tax credit can be claimed with respect to the total value, because I as a developer am going to put all the material, and when I sell the apartments or a villa to a particular customer, to the end user, in that particular I am charging, say out of 100 I will be given a deduction of 33, on 67 I charge 18%. That is how I am going to calculate. But here in the input tax credit they are trying to put a deeming fiction whether that value has to be included. But according to us, because sale of land cannot, it should not be included in the total value. And as I told you, notification cannot override the act per se. And when we read the schedule 2, schedule 3, there it tells land and building only is not covered. So when it comes to section 17.2 and 17.3, where they specifically bring what is an exempted supply, and in that exempted supply they bring only directly sale of land, sale of building, but they again exclude this particular construction activity which is there, which is covered under 5B of schedule 2. They are trying to exclude. So it is not a part of the exempted supply as well. So, and it is neither falling in the category. So this is only for the purpose of valuation purpose, and there cannot be a ITC reversal which is required. So this aspect could be kept in mind. And but the department could always contend that it is we have to pay upon this particular transaction. But always we are of the opinion that there is no requirement for reversal with respect to those amounts. Yes.
I'm not able to understand. In section 17, subsection 2 explanation, it is given exempt supply includes land and security of the valuation. So land, as I am a developer, I am supplying the flats to the customer. When I am doing the GST, I am putting one value as a land value. So now for that exempt supply, do I need to do reversal, like 1/3 value I deducted for the land, no? So that I have to do.
See, as per section 17.3, that is what I was trying to tell. 17.2 and 17.3, there were 4 components which have been brought out. One is security, one is sale of land, one is sale of building, but they have excluded subject to 5B. So what we are paying when a transaction is being sold as a total value along with the supply of along with the land which is being transacted. So there is a deeming fiction. So this deeming fiction of notification what has come is only for the purpose of valuation and paying taxes only. So that is not need not be considered for the purpose of reversal, is my view on that particular thing. That is what I am trying to tell. That is getting excluded in the total value. Okay.
Take input credit on the entire thing.
You can take the input credit on the entire value. That is what we are trying to tell. So then there is one more aspect with regard to, see what happens on a particular day, say on 1st of December or say 1st of January, my project I got the CC. So I got the completion certificate, and I have sold out of 10 flats what I am constructing, I have sold 5 flats and I have entered into agreements prior to 1/1/2019, and there are 10 flats which are done after the 1st of January. Because I have got CC, I need not collect taxes from this transaction. So here also, what happens to the stock of immovable property which is there? Those 10 flats which I executed after 1/1/2019, there is the stock of this material. So as on when I took this particular credit it was an eligible credit because on that day my intention was to sell it only. That is before the CC or OC, whatever is subsisting. But I am not going to sell this. So because of this transaction, because CC came into picture, there are some transactions which are going to fall under the category of sale of land or sale of building as per Schedule 3. So what is going to happen? I need not pay tax on my entire output. So there is one view which we can rely upon, stating that till January whatever is my intention was in the furtherance of business and for execution of the transaction. So whatever credits I have taken can still hold good. So there is no reversal which is required.
No reversal.
No reversal required on that also, because whatever is getting, say as I told 73, they have told. So this particular, there is a conversion from 5B of Schedule 2, it is directly getting into a sale of building per se. So as on the date of credit, so but if you go logically, if you have to go logically, then there could be a reversal required. But as per the provision today, we can still take a stand that there is no reversal required under 18.4 as well. That is another stand we can look at. Then the next one is developer provides only construction services to landowner. This is mainly, basically I am trying to look at a pure labor service. I am providing, a developer is providing only pure labor services. In that particular transaction, generally the rate of tax is going to be 18%, which is going to be support services. That is, all support services with respect to real estate is going to come under labor supply service. All these things will come under 9985 classification and will be charging 9 plus 9, 18%. And what is the consideration value? So the value is going to be the transaction value. If I have agreed per square feet, I am going to charge only for labor, whatever is the labor charges. Say 5,000 rupees is going to be the square feet for 1 square meter of construction area, or it would depend on the transaction what we are going to have. So whatever amount is received, that is the amount which is going to be liable for tax. Okay. So here in pure labor contracts, there is an exemption for single residential unit. So if I have a single house which is constructed, say I want to construct a house for my own self and I am appointing another person to only provide labor to me, and I make a weekly payment of labor charges, those labor charges we are exempted because of this particular thing. But this will not happen if there are two people, for example X and Y, they jointly buy a 30-40 site and buy 2 floors each. So they construct 2 floors each. So in those cases this will not apply because there is a disclaimer or there is an exclusion otherwise than as a part of the residential complex. So a complex could be 2 houses, it could be 10 houses, or it could be 20 houses. So only for a single house, if you have taken a plan sanction for a single house and you are constructing a single house, then there is not going to be a taxable activity here because there is an exemption which is given. And as per PMAY scheme, if I am providing only labor to a particular developer who is doing the PMAY scheme, as per the PMAY scheme, then there also there is an exemption. So here, if I am a builder, I am providing only labor services to few of them and I have another transaction which is taxable, then a proportionment has to be done, and as per section 17 read with 42 and rule 42 and 43, I have to do the reversal, proportionate reversal has to be done. So this is one thing which has to be kept in mind. Then what happens with respect to material plus labor provided by the developer? So here this is nothing but a composite supply of goods and services, or it could be material plus labor, and on the total value of this transaction I will be liable to pay taxes here. So this is clear, you don't have any major confusions here, and these transactions will be treated as a works contract because construction is in turn for the immovable property as such, and it gets covered under 2-119 of the CGST Act, which is works contract definition, and it will be treated as supply of service. So we are not going to charge each and every item, we are not going to look at what is the rate of this product and then decide what is for supply of material and what is supply of labor. There is no dissecting required. So the entire thing becomes a single contract. So single contract, total whatever is the entire, generally that is what is spoken into. Maybe most of the contracts are per square feet. This will be a cost 2,000 rupees. I assign it to you. You give me the bare shell including of so and so, and you have a list of scheduled things which has to be given. Quality standards are set and you collect the revenue. So 1 crore is the total. I want about 2000 square, say about 5000 square feet into 2000 rupees. So it is about 1 crore. 1 crore is the total value. What I am looking at the total constructed area, and I will pay you 1 crore. So in those cases, on 1 crore, you are going to take a deduction of. Are you going to take a deduction? Deduction for 1/3 I will take, and the balance is 18%, right? So I was just testing. So because there is no land included here, there is not going to be any deduction per se here. Only if land is there is going to be a deduction. So this is clear, right? Next. So there is no exemption, and input tax credit is going to be the same here as well. And whatever we discussed about the deductions are going to be looked into here as well. But when we are claiming input tax credit, one thing has to be kept in mind, that all the exclusions we generally have under input tax credit, if we have to claim some benefits, section 17, we have to look at section 17(5). What are all those are called block credits. I will not be able to get any of those. It could be purchase of car, it could be what and not. We have a list of those things: free samples, gifts, and we have insurance policies which have been given, or it could be food, travel, all these things given to employees. All these things are going to get disallowed to that extent. But here, only thing which will be allowed is if I have appointed a contractor. So in those cases, whatever I have appointed, and if it is there in my outward supply, then all those credits will be allowed, even though it is a disallowed transaction per se. Okay.
So I'm a work contractor and I construct one office for my marketing, which will be used for the outward supply. So I am a work contractor. It is written in subsection 5. If I am doing any outward supply, which is pertaining to the work contract only, I can take the input tax credit. So can I take the input tax credit of that building which is using for the marketing purpose?
See, there what happens, there you are doing it for your own self. So if you are constructing, for example, you are constructing your own office, then you will not be allowed to get a credit. So if you are, there are 2-3 concepts where we are trying to look at. I think we'll just finish this. By the end I will try to take that particular point and we'll discuss it out, because there I have 2-3 more things which are supposed to be discussed. I have a few issues which I have noted down in the last. I think it will cover your answer as well. Okay. And there are reduced rates for government and other contracts. See, if few things are there with respect to the government contracts, then there is a separate rate. For example, if it is a PMAY scheme, so Prime Minister Awas Yojana, so where in that particular it's a housing for the slum and the poor people, where each of the house is less than 60 square meters. In those cases, the rate of tax is going to be 8%. Effectively, it was a 12% rate, and there is a given of 1/3 deduction of 4%, which comes up to 8%. Okay. So here, when it comes to the government contracts, we are seeing is composite supply of works contracts supplied to government, whether it's a canal, dam, or other irrigation projects, pipeline, conduit or plant, roads, bridges, tunnels, pollution control equipments, low-cost housing of carpet area, where I told the PMAY scheme, then the post-harvest storage facilities which are given. For example, for the Food Corporation of India, I am doing some particular warehousing which is done. All these are going to be taxed at the rate of 6+6, which is going to be 12% as such. But in the PMAY scheme, if the land cost is included, then it's going to be at the rate of 8%. Then we have the composite supply of works contract to the government. It's going to be 2.5, including mainly it is the earthwork. If it is relating to earthwork, then it's going to be at the rate of 5%, just to be kept in mind. So wherever we are doing the government contracts, I think we have to go through the exemption or the notification for rate, which is 12/2017. We have to look at, 11/2017. We will have to look at the rates which are there, 11 and 12. So we go and look into the schedule. We will have to identify basically 9954, 9957 and 9997. So this is a residuary clause. We are going to see what is the rate which is applicable for these things, and we are going to look at, and we have to see where it is predominantly looking forward. Then composite supply of works contracts supplied by the subcontractor to the main contractor. So if there is a government contract, you have a subcontractor, then with respect to the subcontractor, he will be charging 6+6% total of. Then if it is other construction services other than the above, it's going to be 9 plus 9, 18% per se. So now we come to the favorite subject, which is the joint development agreement of the JDA, which is the major issues. Wherever we have tried to see, there are a lot of issues with respect to always. This is not only from GST perspective, it was under the VAT perspective, or it could be the service tax perspective, or the income tax. So income tax, actually what they did, they postponed the taxability of the event to a different date, where the actual possession was being given or handed over from the developer to the landowner, and the capital gains tax was postponed. But here, I think again we have come back to a day where it could be a possibility of a taxation on the day on which the agreement is entered into. So again, the thing is, when I'll discuss about that, sir. I have all those in detail. I'll just come back to that particular slides as well. So what do you mean by a JDA? As we discussed, because of the property values going up, so there's a landowner who has a pocket of land, and I am going to construct and give one portion which is free to the landowner, which is for the consideration is going to be the land which is there, and I am going to keep all the other transactions as such. So here in this regard, I am going to look at what is the thing. There's an agreement between two or more persons to enter into a contract where by one or more persons provides the land for development, who is called the landowner, and another person develops the land, who calls the developer or the builder. Then we have a share in property so developed that themselves they agreed into a separate ratio. What is the flow of events? So landowner provides the land to the developer for development. So there is something called as a transfer of development right. This is what is the question which is going to be a subject matter of litigation. So that also I will again come back to that point. So then we have developer develops the land, and he has the construction or the structure which is being put into. Then on the property we have two models. One is the revenue model, other one is the area based model. In a revenue model, what happens? Totally there is going to be a single structure which is going to come up. We are not going to identify or differentiate between landowner share and the builder share separately. Total whatever revenue comes out of the total revenue, this much of amount goes to the landlord and this much of amount goes to the builder. Maybe it could be 30% to the landlord, 70% to the builder, or it could be something which is fixed. In area model, you tell 50% of this earmarked area is going to go to the landowner, 50% to the developer. We could take this particular transaction. The landowner sells his marked off properties and the developer sells his marked properties. So this is what is going to happen, and here the critical aspect would be, when is the marking happening, or when are we looking at the allotment of these particular properties? Is it happening on the day of agreement or on a later date? That we will look at. So as we know, again I will not get into section 7 which we have already discussed. So here the only aspect is there is a word called barter and exchange. So the aspect of barter is very important. So when we are looking at the aspect of barter, so there is an exchange of immovable property. Land is being given as a consideration, and in return the owner gets the completed apartments is the transaction, and the department is interested. So here we had a spate of litigation under the earlier law when it was service tax or whether it was VAT. We have been trying, or we have been seeing that there have been a lot of professionals, and from the other side, from the customer side or from the landowner side, we are telling that that's not at all a taxable transaction, because see, landowner is never interested in what sort of a construction happening. I am giving today the land, I want the finished apartment. That is what is my intention. I am not interested in the brick, sand, cement, what he is trying to give me in the totality. That is what we are trying to look at. But the department is trying to tax. So here one of the view is this is unconstitutional, because they are trying to tax the land indirectly. That is what one of the opinion per se. And even today this is the subject matter which could be taken up for litigation per se. But more or less it is settled to an extent, and even builders have taken a call. They don't want to get into litigation per se. Sorry. I'll just take a minute. So here, with respect to section 9, basically basically we want to levy tax only on supply of goods or services. We are not interested in anything else. So here that is what they want to look into. So based on the conjoint reading, so here they are trying to indicate that barter under a JDA, giving of land in exchange of constructed property will be a subject matter of GST per se. They are trying to look at that. So landowner also, his cost or whatever he is getting in return for the total transaction should not cross 20 lakhs, because we have an exemption limit of 20 lakhs. So in that transaction there could be an exemption which could be from the landowner's perspective. So developer needs to discharge whatever is the GST on the flats which is allocated to the landowner. That is the aspect which is supposed to be looked into. So the landowner or developer to discharge taxes on sale of constructed property to the final buyer. If landowner is getting the property and is selling after the CC comes, then it is not taxable. Developer, after he constructs and after he gets the CC, then also there is no tax. Here both of them only during the course of construction. If they are selling, then both will be liable to pay the taxes. That is what the law is trying to tell.
Sir, one case appears the developer will be getting the lot of input credit. Developer will be claiming the input.
Yeah, because he will be claiming the input tax credit. That is where they are trying to tell the landowner share, whatever the landowner is getting, the total value of the constructed area, so that they want to tax. So the developer has to tax the landowner for the stage-wise construction. So that could be at stage-wise you will make a billing. See, ideally if we go on the entire transaction, ideal transaction is, because if if all of them are under GST and if the landowner also wants to sell his project, his share before the construction is complete, then it is always better to charge the GST on all the transactions, because anyway I will get input tax credit and there is no loss of input tax credit anywhere when we look at the ideal transaction per se. So I think this particular thing, revenue based and sharing model I have already dealt with. So here when we get into the other one is time of supply. So time of supply, as per this is the notification 4/2018, which is the aspect where they try to tell that whatever the landowner, once he is giving an entry into the land, they tell that there is a transfer of development right for the developer to develop the land. So there is an easement which he has given an access into the property, and there has to be value which has to be taxed. They are trying to tax that particular aspect, but they are telling he need not pay the tax now. He has to pay the tax on the date of possession or on the date of conveyancing of the particular transaction. That we will look at the wordings, very critical. So the liability to pay a tax will arise as under: when the developer, builder, construction company or any other registered person transfers possession or the right in the constructed complex, building or a civil structure to the person supplying the development rights. So there is a right which is transferred for what? Right in the construction complex, building, civil structure to the person supplying the development right. So I am conveying a title right by entering into a conveyance deed. So here basically or similar instrument. So when generally a conveyance deed happens, so after the transaction or once the transaction is happening, here there is some amount of ambiguity which is there in this particular transaction. It tells that the conveyance deed, when the conveyance deed happens or when an allotment letter happens. So generally when does the allotment letter happen? Generally in, say, if you take a society constructs villas and gives it to you. So after the society, the construction is concluded, generally an allotment letter is given or a sale deed or a conveyance deed is happening. So that is the time at which the actual transaction is going to take place. But here there is another school of thought which tells that JDA, the transaction happens on a particular date. I have on this day decided 50-50 is going to be the total understanding, and out of the 50-50 I am constructing totally 10 flats. In that 5 flats for the owner, 5 flats for the builder. Say we earmark 101 to 105 is for the owner and 201 to 205 is the developer's thing, and this is what is being scheduled, and you also give a power of attorney to the builder. So this all depends on the documentation and drafting, how this transaction is going to happen. So this can actually be, if we look at what is the taxing of the event, it is that the power of attorney given to the builder to enter into the premises. So if I tell only for approvals I am giving it, so in that particular case there may not be a taxation immediately on the JDA agreement date itself if we have not defined what is the area which is going to get. So I am going to just mention that 50% of the total undivided share is going to be governed by the builder and 50% is going to come to the developer. If I am going to mention this particular transaction, then in that particular case there is not going to be any taxation at that particular point of time. So documentation plays a very vital role, and we'll have to look at what is the title which has been given. So but we always look at safety point and we try to put everything under one single document. So there could have been a possibility, and this is one aspect which could be taxation. That could be taxed on the date of JDA is one criteria. But when we look at the actual transaction, if the transaction of conveyance, I have given the right to the builder only after the construction or around the CC date if I am doing, so it gets postponed till the CC date. So there is not going to be a taxation per se. So agreements play a very vital role. So this has to be looked into. We need to look at the documentation, whether the possession or the power or right has been given, or only at stages. Earlier under the income tax, this is why what they were doing, even though the JDA was given, the POA was executed at a later date for handing over the possession or handing over the builder's share to the builder was done at a later point of time. So if we still follow that particular scenario, I think we are postponing the taxes to that particular date where the developer has to pay a landowner share to that particular extent. So in case of continuous supply, yes sir?
That means if the JDA is entered and the landowner is clearly identified his flats in that, there is no question of completion certificate. He has to pay GST.
Because there a conveyance or a right has been transferred to the builder or to the landowner, because you have earmarked and you have told that this flat number 101 to 105 is for the landowner and 201 to 205 is for the developer. Once we are trying to tell that, but I think the intention of law may be a little different because they are telling it's a conveyance deed. But conveyance deed here in the JDA, what is that you have mentioned? Does the other person has the right to convey again further? That aspect has to be looked into. If that aspect is considered, if it is there, then there could be a possibility of litigation. If this could be postponed, then we don't have a much of a litigation per se. So this documentation plays a very vital role.
Unless it is constructed.
Yeah.
Because it is not defined. This area is not defined. Whether it is 101 or 201, it is not
Correct.
defined.
So,
I will not be able to say.
One more question will arise. Unless it is constructed, there is no question of delivery. So, unless it is
correct.
constructed,
That is what, this is going to again open a Pandora box. That is what I am trying to tell. This is going to open. I am trying to give a methodology where, because I am trying to take the earlier whatever maybe from the income tax what had happened. Say, postpone the capital gains, what we were doing, we were telling that the power of attorney was given at a later point of time. So here also, the builder, maybe he can enter into an agreement stating that one unit in this particular thing will be given and he pays taxes on that particular transaction, probably. But again, this has to be examined, tested waters. We need to see how these things could be taken place. And it also depends on the requirement of the landowner and the developer. At that point of time, you get a lot of different options because every single case becomes a thing to be discussed, sought out, and we need to take a decision accordingly.
No, but the builder is giving his GST number.
Yes.
So the landowner is selling afterwards and the GST authorities are coming and asking him to pay the GST.
Not required, no sir. There is no requirement for the landowner to pay, provided only if it comes here also that is what we were trying to look at. It is going to be the transfer of development right. For that particular thing there could be a aspect what they are trying to do, but there also now there is no, the clarification or notification tells that it is postponed till the date of conveyance. That is what. But here what is the analogy we are trying to look at? We need to look into the documentation. That is what becomes the grey area, what has to be looked in. But as per the general understanding, if you look at, it is getting postponed to the date of actual sale, deed. That is what I pursue.
Because the JDA has clearly listed the flat numbers for the landowner. What the GST authorities are contending is that on the date of the JDA, because they are clearly listed, the property has already been given to him and he is liable for...
But see, generally a JDA, what it is a bundle of rights. I cannot only take one point to tell that. So from the developer also there are certain things which have to be concluded, and this does not on that particular day take the schedule. And here this notification is a subject matter of litigation, and already a Delhi High Court has accepted a writ petition which is already filed, and February, I think February first week or so, there is a decision on this particular writ application, because this particular thing again, when we were also looking at the notification for deemed valuation, similar here also, the law is trying to go beyond. See, because transfer of development right was never taxed under the actual statute or under the actual provision when we are looking at, this is given by way of notification. Can a notification define what is the tax which is payable for this transaction without an authority, or a levy itself per se could become a subject matter of levy, because they have not told that landowner is liable on the transfer of development right is one aspect which can subject matter of litigation. You can fight out based on this only. We can surely take this to the writ authorities. We can file a writ in this particular transaction, and I think here also, because a notification is trying to bring something which is deeming fiction, which is trying to create a deeming fiction which is not spoke about in the law per se. So this aspect can again be challenged as such. So this is what is the aspect which is supposed to be kept in mind. So it is not free. We are not telling that. So once this aspect has happened, now the department is telling you to pay, now you can take it up before the authorities to tell that this particular thing is not at all applicable, because notification cannot define a law.
Overrule the law.
Yeah. So you cannot take that overruling. So notification cannot define the law as to, and a taxable event cannot happen by a notification. That is what is, because under section 148 of the CGST law, it specifically mentions only a few of the aspects. It could be registration, input credit, or something as such which are going to be taxed, and it has nowhere spoken about these aspects of levy which can be done under 148. Because of that, this particular provision could be questioned under the law.
In a revenue sharing model, as and when you pay,
Yes, there could be a possibility, because there also, because it is not earmarked. So there in the revenue sharing model, then amounts have already been come. Once it is coming, so there you are very clear, because it is happening during the course of construction. So whatever amount comes, so landowner will pay on his share of receipts which have come, and developer is going to pay on his share of receipts which is supposed to be taking place. But only the developer, whatever for the landowner share, that will get postponed to a later point of time.
no, as and revenue sharing model, as and when we make payment to the landowner, builder makes payment to landowner, to that extent you had to pay.
Yeah, to the extent of landowner, because once there is a amount which is received as per the tripartite agreement, there is going to be a tripartite agreement, and there could be probably an escrow account also. So amount comes to the escrow account. From the escrow account, say 30 out of 1 lakh which is received, 30,000 will go to the landowner and 70,000 will go to the developer, and invoices are going to be raised by both these people, and you are going to pay the taxes. And proportionately, if you want, this amount can be, the developer can raise an invoice proportionately on a regular basis. If you have to map up the credits, that would be an ideal position as such.
But if landowner is not selling to third party, you can argue that he is not into the business at all and he cannot pay GST.
See, there in a revenue model, what is happening is, in a
land sharing model.
Land sharing model, that is where that particular thing is still again under litigation. That is what we have been trying under the service tax also, it was not taxed. Under GST also, now they want to do the same thing. If a landowner is not selling it to the third party, or even if it sells to the third party, what happens is, here because there is a barter and exchange now, sir. So here under the GST law, there is more, a little more authority for the department to collect the taxes. It is always better where you have already collected the advances during construction as a landowner. It is better for us to collect the taxes.
If he is not selling at all, if he is keeping for himself.
If he is keeping for himself, then there is no question of taxes at all per se. Because if he is keeping for himself, only for the construction portion only, there is a possibility. To that extent. So now we come into the next aspect of continuous supply of service. What happens in a continuous supply of service per se? So in a continuous supply of service, any transaction which is more than 3 months is supposed to be treated as a continuous supply of service, and with respect to the contract, what happens? It's a milestone billing. So what is our agreement with the end user or the buyers? What is the agreement? So if the agreement is first, so a particular milestone, so there is a stage wise. So slab 1, so and so amount has to be paid, slab 10, so and so amount, slab 20, then after walls are constructed, so and so amount, plastering, so and so stage. So once the event happens, then you are committed for that particular thing. So your agreements have to be clear when is that particular milestone happening. So or whatever amount has been received from the customer. I have received out of total 1 crore, I have received 20 lakhs today as an advance, then on 20 lakhs I am supposed to discharge the tax of the total transaction if it is during the constructed area. If the total amount is received also, assume I 1 crore, entire 1 crore is received today as an advance, then also I am supposed to pay the taxes on the total transaction value. So here when we are looking at the following events which are taxable here, so here is the flow. So transfer of development rights, so here this is what they are trying to tax, so landowner to the developer. Supply of flats, either developer to the landowner. So supply of constructed flats, then you are seeing the landowner and developer to the final consumer. So this is what is the structure where taxable events is going to take place. So here with respect to JDA, what is the transfer of development right? It's a service, anything other than goods. So it is here also it is treated as a service because whatever the developer is trying to give. So here the easement or the land is being given, authority has been given for this particular people to enter into the developer to enter into this particular building for to the land for the construction activity. Hence that will become a taxable transaction and it becomes a service. That is what if based on the, as I put a caveat with respect to the litigation which could be possible in this transaction.
Valuation.
Value, there you will have to see what is the market value based on, and because it becomes very difficult. So here I just come to the value. There is a separate slide. I'll come to the value on that as well. Then here supply of constructed flats. It is a service as per the schedule we are supposed to look at because here land value is going to get added. Then we are going to see what is the land value and a deduction of 1/3 if land is added. If land is not added, then it's going to be a transaction where it's going to be taxed at 18% per se.
Yeah.
Here the developer is not the owner of the land and how can you transfer to customer?
Because of the JDA, there is a inbuilt transaction. So what happens when the property out of 50% of the UDS is going to get transferred, and because of consideration, see here what happens, out of 50% of the land what I am getting 50% of the apartment. So indirectly when the construction or when there is an exchange of property at the end of the project, say 5 flats is going to the landowner and 5 flats. This 5 flats is in exchange of the land. So I am only putting the construction cost as a developer and this is an inbuilt land value is getting taxed. So that is where earlier under the service tax law also we were trying to tell that this transaction is not taxable at all per se. But again here the supply definition they have made it more wider to include barter and exchange. That is the reason why it is getting taxed. So value of supply, here we get into different models where it is going to be the open market value of the goods or services. So how are we going to arrive at the open market value of the goods or services? So we will arrive at valuation. So different methodologies. So here consideration in money plus value of goods or services supplied free of cost. If anything is there free of cost, so that also has to be looked into. Then we have value of like or similar goods. So here if we don't have any of these things, then it's going to be cost of construction plus markup of 10% is going to be one methodology where we are going to identify what is the value of this particular thing. So this is the most critical area where we generally get stuck up, and this is where we are where a methodology has to be adopted. We will have to work out different models and see which is more convenient for us, and we will have to take based on that convenience. We will have to look at the methodology based on how many is it possible to arrive at what is the market value. Say for a construction activity, you know it costs about 2000 square feet per square feet. So you will take the open market value for that. What is the supporting? So probably it could be take a few supportings or a few quotes. So that becomes a supporting activity, and based on that you will have to bring about the value or bring a architect's or a value certificate which could become a part of the find out the what is the open market value. So that could be taken as a basis for this transaction. So anything which is not available, then we get into the cost of construction plus 10% of market, which we try to see what is the total cost of construction for the owner share. That becomes the value of the construction activity which is there. Or one more thing what we can do is we can take the P&L account, identify what is our total construction cost, divided by 2, or based on the percentage you know what is the valuation as on the particular day. So that becomes the cost of construction plus labor, and add 10% of that value. Or it could be whatever is the guidance value of the property as on a particular day. As on the date of JDA, what is the guidance value? Take the guidance value of the property as on that day, and that is the day if we are paying tax on the JDA date. To avoid all complications, I don't want to avoid. So I don't want to pay, get into this issue of GST. So I identify what is the guidance value of the property as on that particular day, and arrive and pay the taxes. Could be one of the methodology which can be adopted. So here what is the development rights? So generally development rights, it comes under anything which is not classifiable, it comes under 9997. This is a restitutory clause. So there the transaction is 9 plus 9%. So that is 18%, and if it is share of property by landowner, then it's going to be 9 plus. If land is added, then in that case it's going to be a deemed value deduction that comes under the construction services, because land value is again included in the total value. If we take that particular contention, then we can go for a 1/3 deduction, and the same issue which we discussed earlier, the same points are going to be classified here as well. As there is no exemption, the entire transaction is going to be taxable. So now we are going to determine, there are few of the things which we are trying to look at in a JDA. If there is a refundable deposit, then that value should not be considered for the purpose of valuation of GST. Even a non-refundable deposit. What is a non-refundable deposit? So I pay 1 crore plus 50% of undivided, I get 50% of the constructed area. In those cases, what happens to this 1 crore? The builder pays to the landowner. That is the subject matter of levy of income tax only, because only capital gains is going to come, because that is in relation to a immobile property, that is the land, and because of that, that transaction need not be taxed per se. Okay. Then, but for the refundable deposit, there could be a finance cost. So that could become an indirect finance cost. Could be a possibility of another valuation mechanism. Could be a aspect which could be determined. So see, there are a few advanced rulings also which have already come in this particular thing, where they tell that in the first one, where whether the applicant being the landowner is liable to pay tax on the premises allocated to him. Here also in this one case called Patrick Bernard D'Souza. So in this particular case they tell that the landowner is liable to pay. Then here whether the developer is liable to collect from the landowner. Here also they have told in Enforced Infrastructure India Limited, they have told yes.
I think this is before notification.
Before?
Notification.
Yeah, before the notification per se. They have told that it is liable. But notification has only told when it is liable.
Right.
That's all.
Right.
So next we look at aspect of cancellation or assignment of property. What happens? I have, as a developer, I have collected some amount of 50 lakhs from a customer. So what happens if I have cancelled the agreement? So I, as a buyer, I have cancelled the agreement. I tell I don't want the property anymore. Either you have not met based on the standards, or it is not, or I want financial commitment, so I don't want it. I will tell. So out of that 50 lakhs, you deduct 5 lakh rupees. So that is as per the agreement. He tells that I'm going to deduct 5 lakh rupees, and I give you 45 lakhs. So he gives me 45 lakhs. So here, on the 5 lakhs, should I pay tax? And what is the tax I'm going to pay as a developer here? So whether it is in relation to the principal supply what I'm getting now, or is it for an act or a forbearance of an act? We have a particular clause under Schedule 2, whether are we going to pay there, or are we going to pay under any other services, 9997. This is one of the aspects, because there is an amendment to the act. So So where they have told schedule 2 only, it's going to determine whether it's supply of goods or service. That's all. Schedule 2 is going to determine. So first I need to satisfy whether it's a supply per se. So there, indirectly or directly, it could fall under the supply definition per se, and where are we going to fit it? So it could probably fall under the other services, and it could be taxed at 18%, a cancellation. What happens in assignment? Assignment is, I have given 50 lakhs, now I don't want to, in the cancellation there is one more aspect. What about GST credit? So on 50 lakhs, there was 18%, which is about 9 lakhs I have collected, the builder has collected from me, about 9 lakhs, 59 lakhs I have paid to him. So do I need to, can I get a refund of that GST? Is it possible?
Possible. He is going to award it to somebody again, he is going to charge.
Credit note.
Not possible.
Credit note. So what is the time limit for a credit note to be given? What is the time limit?
September to date or
Within September of a particular month or annual return, whichever is earlier, or it is going to be 6 months. We will not go get into 6 months, we will keep this particular thing only. So if we take, we get a little leverage. So for 17-18, so I should have cancelled the agreement before September if it is for this particular period. What happens out of this 50 lakhs, 20 lakhs pertaining to service tax regime, 30 lakhs pertaining to GST regime. And in 30 lakhs, before March 2018, it is about 20 lakhs, and after March 2018, till this, because I am cancelling it today, so it is say 5th of January I am cancelling the agreement. So 10 lakhs is here from April onwards, 20 lakhs is between July to September, July to March, and during the first 3 months, that is the service tax regime, I have collected 20 lakhs and paid tax at say 6% or whatever was applicable rate, I have collected and paid that day. So now what is the amount? Can I get a credit of that? Which all I can get? Can I tell the total value is 50 lakhs and I will pass a credit note for the total value 9 lakhs CGST, 9 lakhs SGST? Can I take a credit of it? Can the customer claim? Customer will always be eager to get the taxes amount reimbursed as well, correct? So here, one thing is we have to be clear that not all taxes could be given back. One, because only for deficiency in a service, only that is going to become an aspect. So if in your document, if we are going to mention this cancellation because of deficiency service only in that particular case, there is a possibility of refund, and that possibility of refund also is going to be within the timeline specified. So according to me, only in the last 10 lakhs, because it has happened in the last 9 months, which is within, because our due date for filing the return is going to go to next year, because September 30th, whichever is earlier. So when we do that, only on the last 10 lakhs, probably I can refund the GST amount. Else, your agreements have to be more clear to state that in case of cancellation, no GST will be refunded. Probably we will have to put that clause so that to avoid confusions and litigations in this regard as well. Because as a customers don't understand all these things. They tell as per, we'll go to the customer court or...
It is not about double taxation. Same property,
Yes.
Yeah. But there is a possibility, because once amount, I again take the amount from a particular person. So in that particular transaction, again the total value becomes taxable. But there is a possibility of going for one more thing, which under the earlier law we had the L&T decision, where it told that up to a date of construction becomes immobile property per se, and only the balance transaction could be taxable. So that we have to test waters and see whether it is possible, not possible. That is another aspect, or that could add some more confusions, and probably we can look at that as to test waters, anything whatever we are trying to look at per se. Then we come to the assignment. In an assignment, what happens? There is a original buyer. The original buyer tells, I don't want the property, but you give it to my friend. So X is the person, he has paid 50 lakhs, he tells, I don't want the property. You assign this right in this property to Y. So in that case, instead of X, there is a Y which is coming, and this Y he is going to continue the contract, and there will be probably an amendment in the contract, and he comes into my shoes and he pays the remaining balance of the contract, and generally there is a transfer fee or an assignment fee which is levied for maybe about 3 lakhs or 5 lakhs they tell for a particular apartment. There is a fixed amount that also in the contract generally they have. So what happens as a developer, I am getting this transfer fee, where do I show this? Whether it is in relation to my principal supply, but as of now all the rates are 18%, we don't have much of an issue there. So for services, most of the services are at the rate of 18%. So whatever is the principal supply, it could be taxed at that particular rate. So, but what happens if it is in some other scheme, maybe it's the PMAY scheme or something where the taxes are at a lower rate, but the cancellation happens, then in those cases, it should be, I am of the view that it could be taxed at a higher rate of 18% in those cases. So if you go for PMAY scheme, the actual rate could be 8%, but here I might have to pay on this assignment fee, it could be at a higher rate. And this assignment also, what happens, the original and what is the documentation or how the builder maintains this transaction, whether he is going to cancel the entire agreement or whether they are going to make an assignment deed and from this person to this person it is just transferred as such, then probably there is something called as contract of novation, and under the contract of novation and the Indian Contract Act, so the other person falls into the shoes of the main or principal supplier, principal person, who is the principal or the original buyer, and there he is going to take the, he is going to continue the taxes, and does not he is going to pay on the remaining whatever amount of revenue which is collected, and is going to pay the taxes accordingly. But what happens if the builder tells that I am going to cancel all the amounts which have been received from person A, I put a credit note for all the transactions of this credit A, this particular original buyer, and I put a debit note for all the new transactions, then there is a possibility, because credit notes cannot be given for the transaction of earlier regime. As I told you, there is a time limit for credit note issual, and there could be a possibility of dual levy for this transaction as well. So the documentation plays a very vital role, and we have to look at and see that in the assignment there should be a simple assignment where there is not much of complication. Probably we will have to move the whatever ledger balance from person X is there to Y. We don't want to get into other aspects of cancellation, because few of the builders I heard that they maintain the accounts in SAP, and that particular they do a credit note for the entire all the old ones and issue fresh debit notes for this particular transaction. But the intention of the law, that should be the main thing than the procedural documentation which has to be looked into. Tenancy rights. What do you mean by tenancy rights? What is a tenancy? Tenancy is, I am the owner of the property, I am giving the tenancy rights to the other person. So tenancy could range from a month or a day to 30 years, 50 years, 99 years lease also, it could be a possibility. Here there is one aspect which we are trying to look at is what happens in short-term leases, and if it is a residential property, what happens? It's a commercial property, what happens? Generally, if it's a residential property, it is not subject matter of, there is no GST because it's an exempted transaction under the GST law. But commercial property will be taxed. Okay. So in the commercial property, what we have to do? We are getting a long-term lease. Whether this lease is taxable. So this has been clarified. So this has been clarified in the Circular 44 of 2018, where it tells that tenancy right cannot be treated as sale of land or sale of building under Schedule 3. Is it right? The subject matter of litigation again, because if a transaction as per the Transfer of Property Act, any property which is given for a long-term lease of above 30 years is treated as a transfer of property as per the law, as per the TP Act, and based on that, that could become a long-term transaction and not subject matter of levy of GST itself per se. But here they are trying to tell in this particular notification that these transactions will not be a sale of land or sale of building. So here they are trying to deem a particular transaction which is going to be taxable today on this particular transaction. And even under the earlier service tax regime also, there were few decisions which have gone against the assessee, and they have told that this transaction was subject matter of levy of the law as such, but this could again be tested waters again under the GST law as such. But if it is anything with respect to any tenancy rights, if it is given, for example, a goodwill, instead of me going for a rental agreement, I tell I will pay 5 lakhs. For 4 years I am going to be in this house. You return me back the 5 lakhs at a later point of time. So whether it's going to be taxable, or I tell I am going to pay total rent every month is 10,000 rupees, but I will pay you at the rate of 5,000 for the next 60 months. I am going to pay you 6 lakhs. Is the 3 lakhs will be the total amount if we calculate at the rate of 5,000. So on 3 lakhs I am going to pay advance rent on this particular transaction. So there also, because it's residential property, they tell that anything which is a residential dwelling, then in that transaction is not going to be taxed per se. Then surrendering of a tenancy right for exempted service, whether it is going to be a taxable transaction per se. So because this is going to be surrender of tenancy rights, which is with respect to an exempted transaction, I think it partakes the character of a principal contract nature, and there should not be any levy per se. That is what is the view here.
What about paying guests? Letting out the property for paying guests?
Paying guest becomes a taxable transaction. No, there what happens is, you are as a PG accommodation, you are into the business of providing residential accommodation for each person. So there it could fall under a category of less than 1,000 rupees per day. So you will have to see that if your PG accommodation is charging more than 30,000 rupees on a monthly basis, then it could be a taxable transaction per se. There one aspect, but this is one which has to be looked in.
Suppose we are given the portion to the PG itself, like one person is running the PG.
Commercial transaction.
That becomes a commercial transaction because you are rendering for a person who is running the business, and that becomes in a commercial nature. So once that is a commercial nature, there it becomes taxable, but the end becomes exempted because generally most of the PGs, they don't charge more than 30,000. It could range from 10,000 to 20,000 rupees a month, including of food per se. There it is a composite supply. Generally we should take a call whether there also there could have been issues whether food has to be separately given, but there it is more of a principal supply nature, again composite supply. So composite supply, no one is coming to you to have food there. The main intention is I want an accommodation, and with the accommodation food is being given. Food is only incidental to my supply, so that's the reason that becomes again a composite supply. Then next we get into layout development. What is layout development? I buy an agricultural land, or I buy a land which is converted into, then I convert that land into plots and I sell it to them. So here in this there is an activity of development which is involved. So what are all the development? With basic facilities of water, electricity, drainage facility, compound wall, then there could be a water supply, you could have a water tank, or you could have a sewage treatment plant which is required as per the BMRD regulations if it is there in and around Bangalore. Then what happens is there is a sale of individual plots. So once there is a sale of individual plots, what is that which is getting transferred? So my intention as a customer, if I am buying it from a developer or a landowner who has already developed this particular thing, my intention is to get a 30-40 plot, that's all. So am I looking at doing, even though there is a development activity, can I still call it as a taxable transaction per se? As per the thing is, I want only an immovable property, and immovable property need not be subject matter of levy because it comes under 3rd schedule and it is called a sale of land, is my view. But here what happens is our document also should speak the same. Our agreement should also tell that I am only intended to have that particular total value for the site, and that particular thing is the amount what we are trying to look at for the site. So 30-40 site, 1,000 rupees, so I am paying 12 lakhs.
No, but in that case we lose the input tax credit. No?
Yeah?
Input tax credit we lose. You charge as a land.
No. There I will come to that aspect also. See what happens is, yes, input credit could become a cost. But there you will have to see as to what is the value of registering also. See, the problem in at least in and around Bangalore is the plot is the actual value of consideration is 12 lakhs. But as per the Stamp Act, I am going to show only 500 rupees and I am going to show only for 6 lakhs as my consideration. And what happens to the balance 6 lakhs?
That is going for
So, is it going for development activity?
Ah,
That is what is supposed to be looked into, and based on that, we will have to plan our transactions and whether the development, whether I am selling it during development, or if we only allocate that this is towards development, this is towards end use, because there are few developers, what happens is, few of the developers and few of the people are very clear, and whatever rate they have told, they also pay the value of stamp duty on the total value. That is what happens. But in few of the cases, what they do is they, as per the guideline value, the transaction is got registered, but there is an extra amount which is received, and they call it as development fee, which was earlier done. So earlier under the VAT, we had something called as Continental Builders case, where it told that the entire was only the development, whatever it was, only with respect to the site which I was buying, and there was no tax in this particular transaction, because it was only the customer was included, only he wanted the land per se, and the roads and culverts or drainage, whatever is there, it generally goes to the village panchayat or the BMRD, that roads and all are transferred to them. So there is no property and goods transferred to the actual end user itself. That was the analogy which was taken under the earlier law, but I think we cannot probably take the same law here. We could continue, but again it depends on the documentation, how we have maintained. If have we paid the stamp duty on the total value? That also plays a vital role, and based on that we will have to take a contention as to what is it. Here we have, one is the self-development, where the landowner develops the plots and he sells it. That is one model. The other one is, again, you have something like a JDA, where totally we have 1 acre plot. There are going to be 20 sites which I will be getting. So landowner may keep 70% of the sites, and 30% could go to the developer. So, or it could be 50-50, depends on the area where we are heading towards. And this is what is going to determine and whether there is any taxability. Because for the developer, generally here what happens, if he has to invest on making of the culverts, drains, water supply, there is going to be a huge amount of investment which he has to do, and this becomes a taxable transaction. That is what is my view with respect to the development activity, and that could be taxed with respect to the transaction per se. And what are all the issues we face with respect to the apartments in JDA? Similarly, here also we are going to face the same logical flow. Whatever we try to discuss is going to be applicable here also with respect to those transactions per se. Then I will take you to the EPC contracts. What do you mean by EPC contract? EPC contracts are the bigger contracts of engineering, procurement and construction. EPC stands for a wider term. So here the contract is for supply of goods along with engineering, erection, design, commissioning, completion of an immovable property. Here there are so many different models. Different states come up with different models. One comes with BOT. You have a lot of transactions, lot of type of contracts also. So again, to add each and every transaction, you have a different analogies which have to be looked into. Now we are going to look at only the aspect what is going to be taxed as such. So in EPC contract, I think it is more of a composite supply of more than one, and it could still be even today called as under the category of 9954 only, and it will be taxed at the classification, even though it's works contract for immovable property there has been given, because a canal or a bridge or whatever you are trying to do, it is in relation to immovable property per se, and it could still fall under the same classification. And the principal supply, there is no, the entire, there may not be a principal supply, or the supply itself could be supply in the execution of the works contract. That is what is going to be the transaction, and the rate applicable will have to get into the schedule, analyze the transaction as to for whom these transactions are entered into, whether it is for the government, whether it is a quasi-government, or whether it's for a private party. So depending on that, you are going to see what is the rate leviable, and you are going to pay the taxes. So here recently under the 31st GST Council, they have come out with a different analogy. Here they are trying to tell, in case of solar power plants, see generally a solar power plant, power generating system plant, if I do the entire commissioning installation, it was charged at 5% because there is a separate entry specific for that. But the rate of the rate of tax for this works contract is at 18%. So different states gave different advance rulings basically, and because of this what happened, one of the state gave an advance ruling that it is charged at the rate of 18%, another one told that it is at the rate of 5%. Here they told it is becoming a construction and erection services, the entire thing comes under 18% and it is not specific to the solar power supply plant. And this particular transaction, what happened, there was a confusion as to what is the principal supply, whether it's a works contract, what is the principal supply, whether it's a composite supply or not. There were confusions. So to avoid this particular confusions, here they have identified, and now the advance ruling authority has tried to create a central advance ruling authority. So now they are trying to create a central advance ruling authority which is going to monitor all the advance rulings which are happening in the country to bring uniformity in the advance rulings, now whatever has happened, and they are trying to bring out a concept of 70-30. They are trying to tell, if you are able to come out, just like our land deduction of 1/3, they are trying to come out here also to tell that 70% is towards goods and 30% towards service, which was already there under KVAT regime or under the service tax regime, where there was a deduction which was given to a particular percentage, and here also there was given a particular deduction. Rule 32L of the KVAT Act gave a 30% deduction or 25% deduction depending on the classification of the works we had. So there were different rates and different deductions were given. So here also there could be a possibility. So this is still in the council stage, so probably as of now we have not got any notifications recently on this particular point as such. So they are trying to come to some, it appears to be on with respect to EPC contracts, they are coming to a modality. But if you are able to prove, as I told you in the Wipro case, if you are able to prove that the material cost is more than 70%, then you can still take a deduction to the extent of a higher amount. Say you have spent itself 70% or 75%, then you can go for 80 or 85% depending on the transaction cost per se. That is what is supposed to be looked into. So this I explained all these things. Then it appears to be, are we moving again back to the VAT regime or service tax regime when we are looking at these particular transactions? They are trying to deem something as something in goods and something in service. So from GST as one supply, again we are going to get in respect to works contracts, we are going to see that there is going to be a bifurcation or artificial bifurcation for levy itself per se. That is what is supposed to be looked into. Next, contractors in real estate. Whether an electrical contractor, what he is supplying, whether it is construction, whether it is a works contract supply or not. If an electrical contractor is doing a work of a building, he is coming and doing electrification of laying wires, then that transaction also is a works contract per se. That is what we look at. But here, with respect to few of the classifications, because with respect to servicing of two-wheelers, so they came out with a clarification stating that material is a separate transaction and labor you can charge a separate rate. So labor is charged at the rate of 18% and material can be the actual material rate. So in future, I think it appears to be that we will be moving to a era where probably again we will be coming into, to avoid litigation, we may be moving to dual contract concepts where supply of material is going to be a separate contract and execution becomes a separate contract. We may be moving towards that particular, depending on the rates of taxes which are going to be after the changes are going to get executed. Co-ownership, X and Y. X and Y own a total property. Property is being owned and 50% for X and 50% for Y. Assume that they both are brothers. Then in that particular case a rent of 35 lakhs is received. So do we need to register and pay tax because it is crossing 20 lakhs?
No.
Why? So, with respect to this particular transaction, they are very clear and they are telling that the transaction is leviable to, you need to bifurcate what is the total rents in that 50%, because whatever is the rent, I am eligible owner for 50% share in this particular property, and so this person X is getting 50%, Y is getting 50%, it is fixed. So in this regard, because I have a share of 50%, my actual right is only 50%. And based on that, based on one of the judgment on the service tax also, it is clear that that time it was 10 lakhs and now it is 20 lakhs, so it will not change the scenario as such, and co-ownership is not taxable. And next I come to the registration aspect. So where do I need to take the registration? so generally where the immovable property is located. So because it's a place of supply, as per the place of supply, wherever the immovable property is located, generally the service provider has to get registered under that particular place as such. Movement of goods, this is one of the very important things where we try to look at how do we move the goods within the state and outside the state. I have 2 or 3 projects which is happening. I have an office in Bangalore, but I have one project in Bangalore, one project in Mysore, one project in Mangalore. Real estate project, I am a developer. So how do I move the goods from one project to another project? Any documentation required because it is within Karnataka? E-way bill has to be generated as per. Any movement of goods has to happen through way of a e-way bill. What happens if it has to move to another location? Say I have in Chennai, I have one project which is coming up. So if I am moving goods from Bangalore to Chennai, then in that particular case, I am moving the goods from Bangalore to Chennai. Do I need to pay? Do I need to raise a e-way bill? I may be sending the material. It could be a sending material. It could be many of these things. Whether it is going to be taxed? Yes. So, because within Karnataka there is no requirement of payment of the taxes, but we have to raise a e-way bill for movement of goods. And do we need to take a registration of this particular place where I am storing the goods? My projects are going to be at different locations. Do I need to take a registration of each of the project, or my head office, if I take a registration? In Karnataka I have, as I told you, 3 places works are going on. Do I need to pay tax on this transaction or not? Do I need to register basically? Do I need to register this particular premises? Yes. Why? Because if it is a taxable goods and taxable goods are stored at a place or a location where each of these transactions are, wherever the goods are located, it could be a transporter's warehouse or a godown or your place of business where the actual goods are getting delivered, then you have to see that you will have to take a registration to avoid complications. So how will the goods be moved? Under cover of a e-way bill. So e-way bill has to be raised for each and every movement of goods from the head office to each of the branches. Wherever it is, wherever the project sites are located, it's better to have a control, and this has to be kept in mind. So whether GST needs to be discharged on each movement of goods. So each movement, as I told you, if the project site is within Karnataka, no tax need to be paid. But if it is outside Karnataka, then that we will have to take a registration specifically. For example, in Chennai, if a project is happening, I will be taking a registration separately there, and I will be moving the goods from this place to that place. So the transaction, it is better for me to discharge the taxes. I will discharge the tax here, and I will take a credit in that particular entity there. So then what happens?
If goods are moved from a group to the group company, in that case, invoice also is required?
Better, yes. If it is a group company, then it could be a different entity altogether. Then an invoice only has to be done. Or you could have an arrangement where timely, whatever you do is you keep having a e-way bill generated for every moment, and because you will have certain criteria which has to be done. Say it is a milestone billing, then you wait till the milestone, and based on the milestone you will be doing a billing for that particular, because that becomes more of a contract basis. So what happens if the centering material, so centering material, or you may have a crane is moved from one place to another place. So in this particular thing, any movement, do we need to maintain records of movement, or is it not required? I am moving a crane. Today a crane is in Bangalore unit in a project in X in Bangalore, but I want it to be moved to Y in Mangalore. Do I need to put it? I am moving the crane from Bangalore to, I will be moving it to site A to site B. Is it required? Yes, it is required, because this is nothing but again movement of goods. So it could be goods, any goods, whatever you are moving, whether it is centering material, whether it is crane, whether it is anything, any machinery, you could take a road roller, or it could be anything. So for every movement there has to be a log that it has moved from so and so project to so and so project. And what is the valuation? That is again another issue with respect to real estate, because centering material, for example, I am using a centering material in Bangalore. So this centering material and scaffolding material, it has a life of say 4 projects. So there are already 3 projects have got done in Karnataka, and one project I am transferring all the centering material to Chennai. Then what happens? So I have to discharge tax. Do I need to discharge tax? Or after the work is complete, the centering material comes back to Bangalore. So what is the valuation mechanism? How are we going to do? So these are few of the practical difficulties. We have to look at each and every transaction. This will be surely taxable because I need to identify what is the value of that market value, any value, but some value has to be assigned, because if the other person is getting a credit in the other state, then the valuation will not be questioned. It could be at any cost, even it could be at 10 rupees or 1 rupee, but a value has to be assigned for this transaction when the material of capital goods are moved from one entity to other entity. So this is one aspect which has to be kept in mind. Issues when projects are in the same state. What documents will be which have to be maintained? So I think this most of them I have covered. I'll get into the other aspects of ITC. So what happens in case of head office expenses? There are a lot of head office expenses in real estate. The head office is in Bangalore. I have registrations across country. Maybe I have one in Bangalore, one in Hyderabad, one in Chennai, one in Delhi. So 4 registrations I have in different locations, but the main operations is in Bangalore. So I have all the management staff who are all there. Maybe all the salaries are also paid from Bangalore. So all the entire expenditure is in Bangalore. My audit fee is in Bangalore. So security or depends on the. So how am I going to do is there going to be a cross charge? Do I need to do a cross charge is one aspect which has to be looked into. But if we consider the advance ruling which was given in the case of Columbia Asia Hospitals, we have to charge. We have to do a cross charge. That is what, whether credit of all goods and services can be claimed. So I think there should not be any denial, because if my end use is taxable, then I can claim all my credits. But in a real estate sector, I cannot carry forward. I can carry forward my whatever if because the rate of tax initially was at 18%, or because of the 1/3 deduction it comes to 12% effectively when land is involved. But my input credit would be at a higher rate. So in those cases, I will not be able to claim the refund of the credit. Okay, I will not be given a refund of that credit. That is what is overflow of credit. I will not be able to claim a refund. So what happens if a model house is constructed? Whether the credit needs to be reversed? I have constructed a model house to show it to my prospective buyers, and after the project is completed, this model house is demolished. So here again there is a aspect whether there is a transfer of this particular property to the buyers. So if we are able to showcase that whatever this model house, if it is a prefabricated, then I am going to use it further for my other flats, maybe all the taps or whatever, each of those are getting used in the construction activity, then there should not be any reversal is my view, because whatever after the dismantling. So but if the entire thing is going to get discarded or disposed of, then I will not be able to get a credit as per 17.5 H, I think, right? So where in one of the clause they tell where it is free samples, or where the it is the supply definition where there is a clear aspect with respect to the disposal, there is a supply. So that comes under Schedule 1 and it could become a taxable transaction per se. Then as soon as I have received a completion certificate from the authorities whom I have applied, whether I credit whatever I have received, I have to reverse. So this also we discussed already.
Sorry, one house is also okay, no? Then we discussed. Because one apartment is completed, we need not go in for completion certificate.
That again you will have to take some because if you have not gone for completion certificate because you have done some violation and you are sure that the authorities are not going to give you the completion certificate, but at least you need to show a proof that you have applied for that completion certificate. You need to have some application, and if you don't have the CC, then you will be showing that the first house or first occupancy you have to prove it to that extent. Then with respect to the last aspect, which is the respect to the accounts and records, generally the accounts and records have to be maintained, very important, and it has to be maintained for a span of 72 months, that is 6 years plus 9 months, say for 2017-18. So from the audit date, the end of the annual return whenever I have to file, so from that day we have to maintain it for 6 years. So now the audit date has got extended to 30th of June. Because of that, now we are seeing that the due date again got further extended by another 6 months. So now the effective, earlier it was 81 months, Now for that particular year it's going to become 87 months which has to be effectively kept. So all these records, where are the records to be maintained? From the place where the principal supply is happening. So generally in a real estate sector, I think it will be there in the head office. But whatever stock records or movement registers, I think have to be maintained at the project site, because each of the site is going to be an additional place for the purpose of the taxation, and you need to maintain the stock of goods, how the goods were moved from A location to B location, because generally billing happens to the head office, but from head office the goods get shipped to different locations, or it could be a bill to ship to. So billing happens to Bangalore, but the shipment may happen directly to Chennai. In those cases, again one billing from Bangalore to Chennai has to happen. So these things with respect to the stock records have to be looked into. Then input credit, whatever is there, we'll have to go based on all the conditions which has to be followed under section 16. We'll have to, along with read with rule 36, we have to see what are the credits, what are the conditions to be satisfied for the input credit. That is, the payment has to be made within 180 days. If you are not making the payment within 180 days, you need to reverse the credit, right? But you will be able to get the credit even after a span of, you will be able to get even the credit even after a later point of time. There is no time limit on that. So output tax payable, how did you pay the taxes, and the payment register you will have to maintain. Tax paid under 93 and 94. If there are any reverse charge applicability for this transaction under 93 and 94, those are supposed to be paid. 94 as of now, there is no 94 because that is kept in abeyance till September 2019. Then advances received and adjustments thereof, because many of the developers even today they keep all the accounts in advances only, because they may not be raising a separate milestone till the project is completed. Then in those cases, or there could be a milestone billing, I have received advance today because the milestone did not happen, so I have to declare that as an advance, and based on the milestone whatever is coming, then on that particular transaction we will have to record the transactions properly under the GSTR 1, table 9 and 11. These are two places where it has to be looked into. Then we have the details of the premises where goods are stored. So every project the goods need to be looked into. So as I told you about the principal place of business, then additional place of business, it is better for us to maintain all the stock records or project record details. So I think if either we could maintain the records in either electronic mode or as per the manual also, manual registers are allowed, and the manual registers are supposed to be initialed and kept. That is what the law permits. Or if it is done in a digital mode, it has to be affixed with a digital signature and it has to be stored. That is what the law prescribes. And it is always better to have a log of the edited or deleted. It should not be edited. So we need to maintain the records to show all the quantitative inputs for providing the services. So I think we need to maintain the records. Project wise details is mandatory. So with this I think I am through with my presentation. So now if we have any queries we can take it up for discussion, and yeah.
Sir, actually in service tax, as per rule 4 subrule 7 of standard credit rule, if you are not paying to the vendor within 3 months, we have to do the reversal.
Yes.
Okay, and whenever we will make the payment, we can take the credit. Fine. So, and there also it is written for reclaiming the credit, there is no time limit.
Correct.
Fine. In GST, the same thing is happened. In transit, now for that bill, I make the payment in this December. So, how can I take the credit?
Directly under 3B you can take the credit. There is no restriction, because you will have to take it under other credits.
So, other credits I can take.
Yes. And the only thing you will have to have a breakup of what are the reasons you have taken those credits has to be done.
But for GST credit, they are showing, or they are saying as per rule 140 sub rule 9, they are saying for taking.
No, 140 sub rule 9 is a transitional credit, whatever you are speaking.
Yeah.
So this is not transitional credit because you told this is under the GST regime.
Yeah, but the service tax, what happened is, the invoice related to service tax.
Now you can't take a service tax credit because that particular amount, whatever you should have taken the credit, or you should have seen that amount you should have taken the credit before 30th 6, because there was a time frame which was given within which if there was any service tax credit, you had a time frame within which you should have done.
Credit. I want the refund of that credit.
No, you can't get a refund now, right?
But then it will be like.
Because the law after 30th 6 2017 onwards, the service tax, there is no forms which are supposed to be filed, so you can't take a recredit. So you have lost that to that particular extent under the service tax law.
technical issue now. If the GST will not implemented, then I would have.
Yeah, that would have been because the law was already given. The law had already given you time for this particular transaction. You should have seen that. You should have made the payment within the time frame.
But I was not having the amount.
Yeah, this will become more of a technical issue because even though if you get a credit also, you will not be able to utilize. So what is the purpose of that?
I can ask for the refund.
No, you can't ask for a refund because now the time frame is already done. You will not be able to file the return itself per se, right? There is no forms itself for you to file because the law itself is not enforced now. That's the reason.
You know, I'm losing my money.
Okay.
That's a very big amount.
Any days of service tax we have to pay or we not pay anything?
For what?
During April to June,
Yeah.
some service tax I am liable to pay.
Yeah,
which
that-
I have not paid.
Yeah, those recoveries will be done.
We have to do.
Yes, those will be done. You have to make the payment
Portal
accordingly.
is still open.
Yes, you can make the payment, sir.
In case of own development,
Own development.
yeah, some portion is retained by the owner for commercial activities.
Okay.
To that extent, the reverse.
Similar to whatever I discussed, sir, the same thing because it will come under 18(4), stock of thing which is kept by the owner. So I feel there is no reversal which is required because at the time of availing the credit, my intention was to sell.
Okay.
So next.
In case of hotel industry, if I am constructing the hotel, can I take the input credit of all the construction materials?
No, anything because under 17(5) there is a restriction. If it is for the own hotel or something, then I will not be able to get. But only if there is an interiors, whatever tables, chairs, and anything which is movable. If it is maybe furnishing, whatever you have done for a restaurant, and or in those cases, anything which is movable, it would be pots. Those sort of all things you will be able to get. But anything which is immovable, iron and steel, cement, all these things you will not be able to get any credit.
So in case of developer, when he makes the purchases, all the input will be in his name. Let's say like landowner, he has to pay the GST. He cannot pay.
So that is where the developer is going to raise an invoice on the landowner to the extent of whatever his share. So he will keep making stage-wise billing accordingly on that.
No, but how the landowner will claim this?
So he should be registered basically. If he is collecting and he is remitting, then the landowner is also going to pay because there under a JDA what happens, the consideration itself as on the date when the transaction happened, the consideration is land. So whenever there is an invoice which is raised, so this has to be set off against that particular share of land which is being given by the landowner. He is foregoing a land for which he is getting some constructed area. So if the construction, say for example, is 1 crore, so 1 crore towards to the landowner share. So 1 crore plus 10% of it you could value, and that could be the valuation which has to be done for the landowner. And on 1 crore 10 lakhs, you will be collecting about 18% of the tax, and you will be collecting the taxes from the landowner to that extent, and that he can claim an input credit as on the date when the builder is going to raise it accordingly. Maybe at first stage, first slab, he is going to charge the landowner say 10 lakh rupees. On 10 lakh rupees, he is going to collect the taxes from the landowner accordingly. Or it depends on the agreement. If the agreement tells the developer has to pay the taxes, then in that particular case, he can surely get the taxes because he will be raising an invoice. So it becomes a cum duty basis. So in that also, anyhow the developer has to show a breakup of the principal as well as the taxes separately. He would have uploaded it. So I get a tax input on that uploading, and he will be raising an invoice. Based on the invoice, I will get a credit, and whatever output I have as a landowner, if I am selling those apartments, then I would have collected from my customers, and this gets set off.
So, limits of ITC. In this, I have a own building. I installed a lift.
Yeah.
Can I claim on that?
Lift probably you could claim because that becomes a replacement of a mechanical instrument, because lift can always be dismantled and taken out.
But it is attached to the building.
Say what I told, without damage, if I am able to take it, because a car, generally what happens is we need to test the waters whether that lift can be taken. It is a separate equipment altogether.
What really happens is the railings and other things which are there on which the lift moves tends to get grouted and fixed to the walls.
Sir, anything which is in relation to repairs and maintenance,
I'm saying how the lift gets fixed is that in case now you have to remove the lift, you'll be able to remove technically the box which moves, but you cannot remove the railings and other things which are
That is what. And then in that particular case, if you are considering that as an immobile property, you will not be able to get the credit. But if I am considering it as a repair and maintenance, anything which is there as a repairs and maintenance, there is a separate exclusion under 17.5. No, under 17.5, if there is any exclusion. So this becomes a replacement of a lift which is required for the purpose of the
very tricky. We are again getting into full component business.
It could be possible. So this could get into a grey area, but according to me, whatever, as I told you, how much is that?
If you see the technical side of it, you will have problems because the way it is fixed, and when you have to remove the old lift, you will never be able to remove the box as it is. You will have to cut through it.
Every has its own dimensions. That cannot be used.
Exactly.
Frankly speaking.
No. Here we are not telling about the dimensions or something. Can it be removed and can the carcass be used somewhere else?
It cannot be. It will invariably be.
So if you are of the opinion that is an immobile property, then there is no activity. But this part, what I am telling is, this lift becomes a part of the repairs and maintenance activity. And if it becomes a repair, see, one lift is getting replaced with another lift.
This will be a full replacement. You cannot look at it as repairs. Your concept of repairs is there is something.
So no. What is the additional?
Please let me explain. There is a mechanical lift. I go and add some electronic control so that it stops and all that. That case I will agree with the repairs or slight enhancement. Here when there is a replacement of the lift, as he also agrees.
Sir, I had a UPS, okay, or a power generation only. No, okay. I have a power generation. I have a transformer. The transformer, again, this is a subject matter of litigation because here there are few decisions for, few decisions again. This is already decided in many of the cases.
Actually, first technically, then you get into law. Here you are getting into the other aspect, which is your side of the law. Whereas I am saying, if you look at it technically, you go and stand at the side, you will see the damage which is done. Then you cannot apply law.
Okay, if you are then in this particular position, I will just stand to mention that if it is a part of the immobile property, then you will not be able to get a credit per se on that particular transaction.
Okay. That is any replacement of tiles, flooring in the office or something. Can we claim on that? Like you told.
Yes, you can claim because there is a particular thing in under section 17.5 where they have very specifically told that anything which is there in respect to repairs and maintenance, and if you don't capitalize the asset, if the asset is not capitalized in the books of accounts, if it is written off as a expenditure, then in that particular case you can claim. Flooring, painting, because all these things are going to be treated as a repairs and maintenance. But as per income tax, what are you going to take a call? Whether it's going to be capitalized, not capitalized. This also has to be looked into when you are taking a call. So it is going to boil down to a position where whether as per income tax versus GST. So you have to take a call whether you want this 18% or whether you are trying to defer that particular asset and you have a longer duration. Are you going to do that? That has to be examined and taken a call. Okay. Yes.
So when construction is in progress for 1 year or more, to avoid getting caught in continuous supply of service, what the builder does is he receives the amount and keeps in advance, and after receiving the completion certificate, he will raise the invoice. So can we avoid the GST in that case?
No. Once you have taken an advance, whether you are showing it or parking it, other than loan, if it is shown as an advance, it is surely going to be taxed.
So you keep it as a contingency amount because
no, you can't do anything as a contingency. This cannot be happening, sir. Okay.
How long are you supposed to maintain site records? Now, some of these site records and projects which are there could exist maybe for a year.
Sir, as per the law at present, it tells that 6 years from the date of the completion of the year, that is from the annual return date, that is 31st of December. So due date of annual return was 31st of December. From that year, it is 6 years which has to be.
But where? Now let's assume in your same example, primarily we are based here in Karnataka. I have done one project in Chennai, somewhere. Now I've gone there, set up the office, the work is over. Now I have come out.
You have to then get the records because you have closed the business, because the department could call you for an audit at any business. Just because you have closed your business, it does not mean that they cannot call you for an audit.
They can call, but what I am saying is technically I may not be keeping the records there. It might
it can be, because you will have to keep it at your head office or whatever you are going to place, because at that place, because you don't have an operation, then you will be moving the records per se. Okay? Yeah. I think I thank you all for giving me a patient hearing, as well as I thank the Bangalore branch and enriching me as well as you. Hope I have done justice by clarifying few of the doubts. If anything particular is there, you can always mail me. So with regard to anything which is not sorted out, we can try to sort out accordingly. Thank you.
Thank you.
Good evening, respected members. I take this opportunity to thank CA Chandrashekar B.D. on behalf of Bangalore branch of SARC of ICEI for having successfully presented his topic issues related to GST and real estate in this last session. And the whole seminar on the real estate, GST planning and retirement planning and everything was superb. We thank one and all for all this wonderful success and particularly for our CA Chandrashekar B.D. sir also. And we, on behalf of Bangalore branch, we would like to present a gift voucher. I request our senior CA Jagannathan sir to please come and present. And we will give a big hand for this. And all the question and answers will satisfy very well, I believe. Thank you very much. Good night, one and all. We continue.